I think we are in a new bull market. So I think there's a lot to be excited about, and 2035 sounds about right. That would be a 10-year bull run from here. Institutions, only about 5% actually own any Bitcoin, but 95% of Bitcoin has already been mined. It's a fixed supply. So if you think about how difficult it is going to be to acquire that last 5%, I can see why it would replace gold or equal the network value of gold, which is over 22 trillion, and that would put Bitcoin at around 1.2 million per Bitcoin. The Fed could end liquidity, and that would create a pullback.
Tom Lee points out that despite two severe corrections, each 20% or more since 2020, the market's resilience signals a fresh bull phase. Two 20% declines since 2020, this is probably more of an early start of a bull market rather than late. This pattern, sharp drop followed by a sustained rebound, reflects historical V-shaped recoveries where rapid recoveries tend to match steep declines. Volatility doesn't always indicate market exhaustion. In fact, when it's this extreme, it often precedes renewed upward momentum.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
We've been up since 2020, but we've had two 20% declines since. So in fact, this has been a really disrupted recovery since the 2020 lows. And so I think we are in a new bull market because we just had another essentially wipeout that happened February to April this year. I do think that the bigger story arc is that there is a big surge in US prime age workforce. That's the millennials and Gen Z. Plus they're inheriting a lot of wealth over the next 20 years, which is going to be transformed into more equity exposure, less credit. And the third is that the US is at the center of a lot of the major structural changes taking place, AI and now blockchain. But those are going to really boost financial sector, which could re-rate to like 40% of the S&P, and then of course healthcare could benefit. So I think there's a lot to be excited about, and 2035 sounds about right. That would be a 10-year bull run from here. Well, Bitcoin has done very well over any 10-year period, and at $100,000 today, it does reflect that institutions are beginning to view this as a legitimate way to store value, because the Bitcoin blockchain is really one of the best ways to record financial transactions with 100% never failed censorship resistance, never fraudulent entry in its entire operation. So, but institutions, only about 5% actually own any Bitcoin, but 95% of Bitcoin has already been mined. It's a fixed supply. That's a stat from Bitwise. But that 5% that isn't held yet, because the other Bitcoin is basically being hodled, has to be acquired by those 95% of institutions. Plus now governments want to own Bitcoin as a strategic reserve. So if you think about how difficult it is going to be to acquire that last 5%, I can see why it would replace gold or equal the network value of gold, which is over 22 trillion, and that would put Bitcoin at around 1.2 million per Bitcoin. In the short term, it's probably unclear if it helps or hurts Bitcoin, because Bitcoin also is correlated with global monetary liquidity. Raoul Paul at Real Vision put up this chart years ago that shows M2 versus Bitcoin, and it's been almost dead on at all the bottoms and tops. Once we would be through Fed interference and the Fed is easing, of course that's good for Bitcoin. But in this period of risk off, I would say it would hurt stocks and Bitcoin. The top is going to have two sources of the negative catalyst. The first is a policy shock. So at the top, the Fed could pull the rug. That's right, not the right term. The Fed could end liquidity, and that would create a pullback. I mean, even a bear market. I mean, like if we saw it in 2022, the Fed had to basically put a heart attack on the economy and the stock market fell. So if the Fed decided that the economy was overheated, there is no bull market beyond that point. But we would both mutually see the warning signs because the Fed isn't operating in the dark and they're seeing the same data. The similar shock would come from a commodity, like if oil spiked to 300. Well, the level has to be, it's a burden on households. So I think it's like now, well, maybe with inflation, it's probably $400 oil. You have to get really high oil. But the second source of a negative catalyst is excess speculation. And that was 99, because in 99, so much money was available, people were demanding that you get on board with a view. So
you don't sense that at the moment?
No, there's not, because there's so many skeptics. On our clients, when we have 400 hedge fund clients, meeting after meeting, and this is interesting, someone inevitably always says, Tom, everything you're saying is fine, but I don't believe you because you're always just bullish. And so they're immediately skeptical of everything we just said. We could lay out everything for 30 minutes and they'll say, but you're always just bullish, and they don't believe me. So there's skepticism at these levels. That's not a top. Margin debt's something we can measure. It really needs to have a meaningful leap above the prior high to signal a top, and we're not there yet either. When you're investing, you should really think of it more as you're buying companies, not just buying the stock market, because then you'll have a lot more conviction about what you own. You know, I think when people really understand Tesla or Palantir, and then they don't worry about tariffs and inflation because they know that these are really smart companies. So I think if the more they believe it as a series of companies they own, the more likely they're going to hold on to their stocks.
Lee encourages investors to think of their portfolios as collections of businesses, Tesla, Palantir, etc., rather than faceless market indices. This mindset fosters long-term conviction, helping investors remain committed through macro noise, policy shifts, or headlines. He suggests market derating might begin once yields breach 5 to 6%. Moderate yields can empower earnings and support valuations, but extremes on either end are precarious.
Fed independence is really important because the Fed is the single most powerful entity in the world, right? Because what the Fed says triggers an instant response across all markets and CEOs and policymakers everywhere, and even governments. So that being independent is critical. I think that we're going to ultimately find that the administration does see to what markets rationalization is, and I think the markets don't want to see a non-independent Fed. So I'm going to lean towards the idea that Fed Chair Powell serves his term. But even if it's just noise now, it is just someone comes across as more not happy with policy, but they're not going to interfere. If you don't put governors in how spending takes place, then governments keep expanding the pie, and we don't want to crowd out private sector spending. So I think there is a lot of negative implications for a budget deficit, and then of course the debt burden that comes with it. But there are a couple things I would just highlight as offsets. One is that the U.S. has a really big balance sheet that's basically valued at zero. If you compare the U.S., they own a lot of assets that other countries have already privatized, whether it's the postal system or in the U.S.'s case, even how they're valuing their gold holdings, national parks, land, resource rights. I think I've seen informal calculations. This does come into the tens of trillions of dollars. So the U.S. is a lot less indebted than it looks. And the second, of course, is if the dollar's dominance is set to grow in the next 20 years, then this is not a problem. So it really comes down to whether dollars are being more accepted over time. We look at the general relationship between yields and PE or risk premium. You can use any metric, and it's not a linear or even exponential relationship. It's actually dynamic. So below 2%, when yields are below, and this is pretty true with most countries, PE tends to actually decline the lower the yields go because it's more of a deflationary environment. But between 2 and 6%, higher yields are associated with rising PE. Because I think that, and I've seen academic work, generally somewhat higher elevated nominal growth and even nominal inflation, 3%, is good for corporate earnings because companies can out-earn that cost of capital. So PEs tend to rise. So between 2 and 6%, you'll actually have rising realized PE. So as yields get to 6, I actually think PEs would go up. But then after 6%, of course, you start to really crowd out private sector's ability to out-earn the cost of money, so the PE should fall. So I think, yeah, I'd say between 5 and 6%, you have to start derating the stock market. I think they're disrupting themselves in a way because, well, here's something to keep in mind. First of all, I know Peter Lynch famously said the reason he got out of Japan in the 90s was he looked at the top largest companies in Japan and they were all financials. And so he said to himself, like, okay, wait, if it's all just financials, like there's something wrong with that economy. And he sold Japan. But I think JP Morgan is very, and Goldman are really different because number one, in the post-GFC period, they were highly regulated, almost forced to not make money. And they, under those conditions, generated really good shareholder return, earnings growth. So they became essentially nimble under a huge regulatory burden. And then in the last few years, we essentially shot up the economy with like inflation, Fed hikes, things that should obliterate banks, caused housing to screech to a halt that should really hurt banks, and they produced good earnings. So they've been battle tested, but we still treat financials through a 50-year story arc of their returns, and price to book governs the valuation. But now they've got two big tailwinds in front of them. One is AI, which is really going to be a tool for them to better understand credit relationships and customer relationships and even customer attachment. And of course, ways to more profitably lend and participate in markets. And the second is blockchain, which could radically reduce their cost. I know that, and I can share that during COVID, one bank told me, and I do interact with a lot of companies because we get asked to present to the board, that during COVID they had every employee had to do VPN. So they essentially have surveillance because they know who's logging in and what keystrokes they're doing. 80% of their employees did nothing during COVID. So they still made good profits, but they know that 80% of their employees did nothing. So the banks know they can re-engineer their entire operations around AI and blockchain. JP Morgan could have more profits, but the biggest cost in their business is employees. So that means if you shed employees, then it's shareholder return that benefits.
Tom Lee lays out a compelling multi-decade growth thesis anchored by demographic shifts, U.S. structural leadership, and the rise of digital assets. Despite volatile bursts, the recovery is real, and we may be only at the ascent's beginning. Now's the time to think strategically. Invest in businesses, not buzz. Monitor yield fluctuations, Fed policy signals, and Bitcoin's evolving role as a digital safe haven. If you found this breakdown eye-opening, hit subscribe, ring the bell, and share with anyone navigating today's market cross currents.